Hey everyone, it's Mitch Goldberg. It's 4:30. We're getting ready to go live right now. Let's just put up what this is all about today. Let's put up the thumbnail right now. Teck Wreck coming, comparing. Let me say that again. Teck Wreck coming? Because it's a question. Comparing the year 2000 to 2021. That's what we're going to talk about today. Are we building into or about to step into another Teck Wreck? Are things about to fall apart? Or do we just go right on like we're doing right now? Just a couple of down days in the market and we go back to new highs. I see parallels to the year 2000. I want to talk with you about what I see, why I think it's very important to acknowledge them, because remember, those who forget history are doomed to repeat it. And we're going to have a good show. So let's roll the quick intro, and then we're going to get into it. Here we go. All right, welcome. It's 4:30. It's Mr. 4:30 right now. Hey, I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This show, I do this live stream every Monday through Thursday at 4:30. It's all about helping you take control of your money. It's all about you knowing what you should know to be better at your own personal finance. I'm here to actually put the personal back into personal finance. So we're talking about tech stocks. We're talking about a Teck Wreck. Now, I just want to start off by saying a couple of things, if you will, some ground rules for today's show. Okay. First of all, let me turn on camera number 2. Here we go. You know, a little prep goes a long way. Okay. I usually have those cameras on before I get the show started. But those are the vagaries. Look, you have to understand something. Going live is not my full-time job. I'm a financial advisor. I have clients. I run a business. I have a family. I have hobbies. I have interests. This is something that is more than a super hobby for me. I love going live and I love teaching. And for what it's worth, it is pretty good for business too. I don't have to be apologetic about that, do I? I love it. And this is my way of giving back. I enjoy it. And sometimes good things come from it. But every day, actually, something good comes from it because I love doing this. So I see a few people out there. So let's really get into this, okay? The Teck Wreck of 2000. I don't know how many of you who are watching this remember those days, but the Teck Wreck of 2000 was not like, it wasn't a minor event. It wasn't a bad week or a bad month or a bad season. The Nasdaq went down about 80%. I want to put this into perspective of how bad that time was. It was really bad. When the Nasdaq bubble finally popped, it didn't just pop. Stocks went down a lot, and then you just bought stocks cheap and everything went up and everybody was happy. No way. So many companies, the hottest stocks, the ones that people owned, literally went to zero. I'm not talking like a stock that went from 100 to 30 and then years later it recovered. I'm just talking about plain old hardcore permanent losses of that era. That's how bad that time was. So we have to put this in perspective. When the Nasdaq bubble popped in the year 2000, it was in March of 2000. It didn't stop popping for 3 years. It just went on 3 freaking years. And there were plenty of sharp rallies. There were plenty of, mini bull markets that would last for a week or 2 weeks or even a month, only to draw investors in just enough to say, oh, it's time to buy. Everything's going to go right back up. And then the market just tanked again. And every time people went in to buy because everything's going to go right back up, The market tanked again, and this went on and on. 3 years, my friend, is a long ass time to go through a bear market. That was way worse than the bear market we went through in 2020, from the COVID pandemic. I mean, oh my God. So that, first of all, the market didn't go down as much. The S&P 500 in the year 2000 went down over 50%. The S&P did not go down 50% from the 2020 pandemic market crash. It went down about almost 40% and recovered pretty quickly. I'm talking about Nasdaq going down so much that it didn't recover until 2015. And many, many stocks took even longer than that to recover. How many of you, show of hands, how many of you are willing to buy a stock that goes down 30, 40, 50% or more and hold on to it for 15 years or more for it to come back? I bet if you have a stock like that, I'll bet anything that you will not hold on to that stock for 15 years. You will have jettisoned the stock and have gone into something better. And believe me, in that time, anything you would have gone, and believe me, at that time, anything you would have gone into would have been better. That's how bad it was. And it was endless. It didn't end. It was torture. So I want to put that into perspective. I see parallels today that bring me right back to the year 2000, to the Teck Wreck. I want to talk to you about these. Now, I said in the beginning a couple of ground rules. So here we go with the ground rules. I'm not trying to be alarmist. I'm not trying to get you to sell everything and scare you. I'm certainly not shorting the market, okay? At this moment, I have nothing short and no put options. So I'm not doing any of that. I'm simply saying to you, it's more than now, to me personally, it's more than just seeing some parallels to those dark days of 2000. Another ground rule is, this is my opinion. This is not my recommendation for you to go out and sell everything you have and hide under a mattress. Hide under your bed, put all your money in the mattress. That's not what this is for. This is to put in perspective what I saw then, what I see now. I was around then. Listen, when the year 2000 came around, I had already been a financial advisor for 10 years. So I wasn't exactly a rookie when it happened, but I made mistakes. Plenty. And I want to share these mistakes with you. That's one of the main points of the show. That's how I teach people, by teaching you mistakes that I made to make us all better. By repeating verbally, by talking about the mistakes, it helps prevent me from making them again, and it'll help prevent you from making them in the first place. That's I hope you find value in that. 32 years as a financial advisor. So it was a bad time. So the ground rule is just not trying to be alarmist, not saying this has to happen. We have to have a Teck Wreck, but I'm going to share with you, starting right now, some of the things that I'm looking at. Okay. We could get into the market and how the market did and all that. It was a good day. The Dow was up 600 points. So maybe we'll, Nasdaq was up 0.83%. S&P was up 64 points. Oil was up a little. The 10-year yield was up a little. The VIX is below 30. It's like 27.95. It was a good day today in the stock market. A nice bounce from yesterday. It doesn't mean anything. I said to you yesterday, when the market went down, and when the market went down last Friday, 900 points on the Dow, I don't do anything differently. I talked about this on my live stream like every day this week. It's Thursday, so I talked about this 3 days in a row. I don't let market swings control me. I control me. I decide what I'm going to do next because I have a plan. I have a strategy. I have this plan and strategy in place for my clients. Sometimes the best thing I could do is nothing. Occupy myself, fidget, fidget with my pen, tighten the screws in the microphone. I don't know, make pretend, I'm talking in front of a live audience. All right. Do something, but don't tinker in the market at times like this. Sometimes the best thing is to do nothing, as long as it's a conscientious decision and not because you froze like a deer in the headlights. So let's get into this. So much to say and so little time. I am on this kick of parallels or echoes or history repeating itself with regard to 2021 and the year 2000 for a couple of reasons. But the thing that's really doing it for me is this. First of all, you take a look at the hottest stocks of this year, tech stocks or tech, at least tech related. You look at Zoom, you look at Zillow, you look at uh, Peloton, you look at DoorDash. You know the names. We talk about these names all the time. These stocks have gotten crushed. I mean, just absolutely destroyed. If you're just in the indexes, you're just an average, you're just an average index investor. I don't mean to call you average like it's a bad thing. Just like if you're just investing in the indexes, you wouldn't even know because the major averages are still very close to their all-time highs. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference. But similar in 99 and 2000, some of the hottest, best, I have to do air quotes, some of the hottest, best stocks, popular stocks, were already getting crushed ahead of the peak in the Nasdaq and the S&P and the Dow in March of 2000. They were already getting killed. So many stocks were getting destroyed. You just didn't know it because the biggest ones still held up, because what investors did then is they would get out of stocks that would get crushed, like Global Crossing, Frontier. Some of the best stocks you could own were Nortel, Sun Microsystems. I'm telling you, the best two true blue internet stocks that you could have owned in 2000 were Yahoo and AOL. They were the best. They were the blue chips of the business. Everybody had to have those two stocks in their portfolio. They were stalwarts, widely held. Look what happened to those. I mean, I don't even know who owns Yahoo anymore. Last I heard it was part of Verizon, but we don't even know where it is, what it is. AOL, I think I have one or two friends who still use an AOL email. I'm surprised like it even works. Okay, they disappeared. But even ahead of those two disappearing, stocks were already getting crushed. And like then, you had eSpire and RSL Communications, Frontier Communications. You had At Home, which was a high-speed internet access provider. You had Excite, which was a popular search engine. Stocks were getting crushed. And finally, in March of 2000, liquidity ran out for the largest companies in the S&P 500. What happened was people were selling their third tier and second tier internet/tech stocks, but they didn't want to be out of tech. So they were putting that money into Cisco, into Intel, into AOL, Yahoo, into the big heavyweights. Until finally one day the money ran out, the liquidity started to dry up. The number of IPOs, of new stock offerings flooding the market with stock supply, finally just became too much. Liquidity going down, Fed raising rates, and all of a sudden these stocks started to go down, and there was literally no one left to buy. There was no buying, no money. So there were only sellers, no buyers, and these stocks plunged. They plunged, a lot of them in slow motion, which is even worse than a fast motion. We like a situation where we could pull a Band-Aid off. If you pull the Band-Aid off slow, it hurts, but you pull it off fast, it's much easier. This was slow burn. It was rough. Like 1999, the Fed was raising rates. In the year 2000, the Fed was raising rates. It was tightening. It was taking liquidity out of the system. When the Fed raises interest rates, that means it's taking liquidity out of the system. When the Fed puts liquidity into the system, a lot of that money finds its way into the stock market, and stocks go up. There's money to buy stocks, demand for stocks. Fed's tightening now. And granted, they haven't raised rates yet, but they are cutting back in their quantitative easing, which is a form of cutting back on liquidity. And after that, after the Fed's done with its taper, it's expected to begin raising rates. That's a similarity that is you can't dispute it. This year, I'll just show you my screen here. I'll show you a quick headline. IPO boom. Rivian pushes value of companies that went public this year to a record $1 trillion. $1 trillion of new stock offering. Like 99 and 2000, there were just an endless amount of companies that were going public, flooding the market with new stock. It was absorbed because people were so enthralled about tech stocks and internet stocks. There was a lot of FOMO. There were all kinds of new investment products, unit investment trusts and mutual funds that were coming out that specialized, that concentrated on internet and tech stocks. The Monument funds, the Munder Net Fund were the really popular ones. Van Kampen Select Growth Fund. I mean, every fund was tech, became tech. Even funds from Fidelity, their growth funds, their Contra fund, those all just became tech funds after a while. That's all anybody wanted. That's where people got returns. So they were overowned. But there was a ton of liquidity that started to get pulled back just like now. There was a flood of new stocks, new stock supply hitting the market just like there is now. $1 trillion this year. It's a record. Okay. So it's another parallel. The volatility we're seeing, similar. I know we've seen plenty of volatility in the last 21 years. Don't get me wrong. Look, I just want to say, I am not the first person to come out and say, "Oh, whoa, there are parallels between the Nasdaq of 2000 and the stock market today. There are parallels." Why now? It's because liquidity is being drained from the financial system because the Fed is about to withdraw the liquidity that it's been providing. That's what happened in 99, 2000. It's what I see happening now. Liquidity is the fuel that keeps stocks elevated and going higher. Okay? You pull back on the liquidity and you've got a flood of new stocks, plus the stocks at sky-high valuations, up a lot. It's a really nasty combination. I saw that then. I see it today. I'm telling you what I see. You are welcome to dispute that, disagree with me. In fact, I'd love to hear why. Again, I'm not making an attempt to say, let's all get bearish and sell everything. But I want you to know what I see happening because my eyes are open to it because I've seen this movie before. And I'm watching like the same movie, but it's a remake, so it's slightly different. It's the same thing. Meme stocks, SPAC stocks, speculation, super high growth, but super, super high valuations, super aggressive. Okay. Why do you think Rivian is down to 106 today? It's almost down to its IPO price. I don't know if you saw that. Okay. Speaking about Rivian. All right. So that's what really sparked this in my mind is the Fed pulling liquidity out of the market. And the other day, Chairman Jerome Powell, chairman of the Federal Reserve, said before the Senate Banking Committee that he sees the economy as strong, inflation. He was talking, he said he wants to retire the word transient when he describes inflation. And they could accelerate the taper by a few months. I mean, the Fed was going to finish their taper by next July. It was going to be a 9-month taper, 8-month taper. So if you cut it a few months short, that's a lot. Cutting it down to 6 months or 5 months, that's a big deal. And then you get closer to raising interest rates. Okay. So I'm not saying a crash in the Nasdaq where the overall market is imminent. But unlike the Teck Wreck and the market allocation leading up to that, tech is a much bigger part of the market today, a much bigger part of the S&P 500. So if we have a Teck Wreck, it takes everybody down. There's no place to run, no place to hide. And even if you're in other stocks besides tech, money comes out of the market because sometimes investors, like institutional investors, need to raise cash, maybe for redemptions. They're not selling what they want to sell. Sometimes they're selling what they could still sell, which could be drug stocks or industrials or banks. So beware that tech is so big. I always call the FANG M stocks: Facebook, Amazon, Apple, Nvidia, Google, okay, and Microsoft. I call those stocks, the black hole of the market because it sucks everything into it. If those stocks go up, they pull the whole market up with it. If they go down, they pull the whole market down with it. That's why I call them the black hole. Okay, they suck. Okay. Inflation pulls money, and I want to make sure I'm covering this because I think I'm making some very, very strong points. Okay. So back then, you had the advent of day trading firms. Now, people, you might think, like, why would anybody work at a day trading firm? Listen, back then in the late 90s, not everybody had high speed internet access. And the few people that did have high speed internet access, I was one of them. I had high speed internet access through my cable company, which was incredible. And comparing that high speed data, the high speed connection to today, it was painfully slow by today's standards. So most people did not even have internet access yet. But you had to go to a day trading firm and they would teach you how to trade stocks. You would go to Broadway Trading or Schoenfeld Securities Trading, and they would teach you how to trade. They would provide you some money, and if you were good at it, they would let you trade a little bit more, and you keep a little bit of the profits, and that's how you made your living. And these firms had T1 lines, they had computers, they had the technology. Today, you could do that yourself. The cost of technology has come down, and we all have super high speed internet access today. So it's really a lot easier. But people were day trading. The hubris, the unmitigating, colossal nerve, chutzpah of young people day trading. The overconfidence was stunning. I know, listen, I was 33 years old in the year 2000, but people were so confident. They thought they knew everything, and people are trading online. I made money in this, I made money in that. Very similar to like what went on with the meme stocks and crypto. It just got easy. People started to think, this is pretty easy. Is everybody else stupid? Everybody says this is dangerous, risky. These people are idiots. We're in a new paradigm, a new era. These people are idiots. They don't know what they're missing. It's easy. Well, people today are, and this is one of the marks of a bubble bursting, is people keep going to the same old stocks. People think that Clover is going to go back, from $4 back to wherever it was, or they're going to jump into AMC and they're going to ape the stock right back up to its old highs, not realizing that the company issued so much stock that they don't even know what the stock should be valued at anymore. It doesn't happen like that. People think that, oh, the market's corrected enough, I'm just going to buy these hot, momentum stocks of the era, and they're going to go right back up. By the way, this mistake, and I call it a mistake, this has been repeated by every generation. The Teck Wreck of 2000 was 21 years ago. So that was me. That was my generation. And I'm trying to keep you from making the same mistake. If you take money out of your tech stocks, your hot momentum stocks of the day, find something else to buy. Go somewhere else out of tech. You don't have to be tech. But people are so used to making returns there, they think they're comfortable with it. They are comfortable with it, complacent with it, and they keep going back to the well. And it's a recipe for disaster. It has been a recipe for disaster. Okay. And then let's take a look at some of the other things. People compare crypto. All right. People are comparing what's happening now with crypto to the early days of the internet. That should scare you. The early days of the internet turned into a very dark period, like a nuclear winter for investors, because nobody knew which internet stocks would work. Most of them just disappeared. But you thought, in 2000, 1999, you'll buy a basket of internet stocks, or you'll buy a mutual fund. It didn't matter because the real winners didn't even emerge yet in the internet. I want to give you some stats or birthdays, okay? Netflix. Netflix, by any definition, is a huge stock market winner. It didn't go public until 2002. Google, one of the biggest winners of all time. Nasdaq, internet, right? It didn't go public until 2004. Facebook, huge winner. Didn't go public until 2012. So the stocks that wound up pulling the Nasdaq up, you could take a look at Amazon and Apple and Microsoft. They were around, but the drubbing that they took, Amazon went from like $150 to $7 and stayed there for a long time. You probably wouldn't have stuck with it. But that's the point, is the stocks that took the Nasdaq up, because it wasn't just Microsoft and Apple. You needed the market cap, the heft of these other three companies, Netflix, Google, and Facebook, to move the market up to its current valuation, to its current price levels. That is significant. So they didn't even come out until after the early days of the internet. So when you compare crypto to the early days of the internet, I'm thinking that, pretty much any crypto you have today, when crypto finally becomes broadly adopted, or some version of crypto becomes broadly accepted, and we have the real blockchain that everybody uses, it's probably nothing that is in existence yet. That's how risky this stuff is. All right. I see somebody out there. James is out there. You need to clip this section about day trading. It's at about 22 minutes. Thank you very much, man. And thank you for watching, by the way. James Wrigley is also a financial advisor. He is in Melbourne, Australia. But they're just like us. They're just like us. They're doing the same things. Quality advice, fiduciary, planning. Go follow James Wrigley. He's a good guy. We're also friends on Facebook. One day, James, you and I have to meet. Okay, let's take it to the screen. Okay, I want to show you this LinkedIn post that I wrote today. Folks, if you're not attached, connected with me on LinkedIn, please do so. But one of the notable investing patterns from the Teck Wreck of the year 2000 that I see now was how investors kept going back to the same momentum stocks every time they dropped, as if a sudden shot down of 20% or more meant that a tech-related stock has to go right back up. Also back in 2000, it was as if investors' repertoire of stocks only included tech/internet stocks, similar today. It's the same thing. It's always the same thing. All right, I'm going to get to my watch list. Let's take a look at how. You know what? I don't want to get into how all individual stocks did today, because this is, I think, a bigger thing. Let me get back to this. All right. Late 99 and early 2000, momentum stocks are already cratering. That's what I was talking about before. The DoorDashers of the world, the Zooms of the world, the Zillows of the world. These were like the greatest stocks. They're going to change the world, and everything's great. They cratered. And this was happening in 99 and early 2000. But people just didn't realize that. I mean, people look at these stocks that I just mentioned like it's a short-term phenomenon, and they're just going to pop right back up. It doesn't work that way. Sorry. Zoom, Peloton, PayPal, other momentum stocks of the current era, what we're now, have been obliterated. Back then, there was a massive amount of new stock offerings. Today, the same thing. We went over that. The culprit then was shrinking liquidity. Today, same thing. Fed was raising rates then. Fed is pulling back on stimulus now. Back in late 99, the stock market was already in a stealth bear market. I think there's a very high risk that we're in the same situation now. All right. I'm kind of starting to repeat myself. We're just about up to the half-hour mark, which is where I like to end things. And I think anything else I add to this is knock it up. One last thing I'll add. Superstars. We had the Munder Net Fund, Monument Fund, and other hot funds back then. Today, we have the ARK funds and Kathy Wood. I have nothing against this person. I've never met her. I read her material. I've seen her videos, and she's very smart, extraordinarily convincing. And she makes incredibly bold predictions. But I feel that no money manager should be the superstar, should be greater than the firm that has fiduciary responsibility to manage client money. And she's not greater than the process. So I see, superstar or exalted or media exalted fund managers like Kathy Wood as another sign of a top, because we had the same thing in 99 and 2000. I'd like to thank you very much for watching. Andrew, a couple comments. This sounds like a great talk when I wasn't on the phone. I need to play it back later. Please do so. If you enjoy it, please, share it on your timeline. Let people see it. I'd really appreciate that. It'll help grow my audience, and that is something I'd like to do. Missed it for today. Well, it'll be on it'll be on my timelines forever. So check it out in the replay or listen to it while you're working out. And by the way, Filippo, you're really getting up there in the weight on the squats. It's a lot of weight that you're doing, and I'm really impressed with how well you're maintaining your form. And that is the way to do it to avoid injury, and that is really awesome. Thanks, guys, for watching. I'll be back Monday unless something happens in the market that's crazy tomorrow. And I really appreciate your time.